I want to walk you through the 7 ways that everyone from beginners like you and me, all the way up to multimillionaire investors are finding money to do deals. All the way from flips to buy and holds, turnkeys, all the way up to 100 multi-unit apartments. This video is going to be the first video in a long series of videos coming up this year that every new investor needs to hear. I'm going to walk you through step by step on how to find money to fund your deals. Because at the end of it, nothing else that I'm ever going to teach you matters if you don't actually have the money to do any of these deals. In this video, you're going to learn about the 7 different ways that you can finance a deal, learn how to find and use this money in the absolute best way. And if after this video you don't know where to find the money, then I don't know if anyone can help you, because this video is going to be detailed. I'm going to be talking about traditional financing, hard money loans, private money, partnerships, lines of credit, seller financing, and also crowdfunding and syndication. And stick around to the end of the video because I'm going to teach you about how to combine a lot of these. Now, before getting into this very first one, there is a key foundation that we need to create. There are 3 stages of funding and getting money. There's the acquisition, the rehab, and then the long-term hold. Each of these are crucial, important, and can vary in how you approach it. Acquisition is very simple. That's the loans that are going to help you purchase these properties. A rehab is the money that you use to put into these property, whether it's just some simple cosmetic work or a full gut and renovation. And then the last step is going to be a long-term hold. This is going to be your traditional mortgages. You're going to refinance to get these mortgages. Your rent is going to cover the payment, give you some good cash flow. So let's jump into the very first way of financing, which is going to be your traditional financing. This is going to be where you simply go to a bank and you're going to have to get a conventional loan, put 20 to 25% down. And these are really, really good for properties that don't need a lot of work, or actually if any work. Those properties are what we call turnkey properties. They're properties where you go in, maybe you have to do some cleaning, and they're ready to rent, or in some cases, there's already a renter in place. Typically, you'll find these at a bank, credit union. That's going to be the main sources for these, JP Morgan, Chase, Wells Fargo, local credit unions. That's where you're going to get these, and they're going to usually require you to put a minimum of 20% down. Sometimes they'll require 25% down depending on your credit. Now, these loans are really good because they do have lower interest rates. They're great for long-term stability, but like I said, you do need good credit. So if you plan on going this route, then you need to make sure your credit is at a minimum of 680, but anything higher than a 7 is preferred. And because these are going to be done through your banks, a lot of times the lending process is going to take a lot longer than maybe a private lender and some other things that we're going to talk about later. It may take 30, 45, maybe even 60 days to completely close on a loan like this. And one very key important part is most of the time these lenders will not fund a distressed or ugly property. So if you're looking to get into a property very cheap, put good money into it, renovate it, and have a lot of equity, a typical mortgage is usually not going to work for this. Now, one tip that I can give you for these type of loans: please make sure you're getting pre-approved before you do anything. A pre-approval process is so simple, so straightforward. They're just going to ask a bunch of questions, get financial docs from you, run your credit, and they're going to tell you how much of a loan they're willing to give you. Now, if you're an investor who is really looking to improve a property, you're not trying to just buy something turnkey, you really like the idea of buying something ugly, fixing it up, and having a lot of equity, that's where this next one comes in, which is hard money loans. These are going to be loans that are offered by private lenders. Usually banks don't typically offer this. There's going to be, different businesses out there, different lenders that are completely private. And these are great because they are short-term loans. This type of loan is what is meant for real estate flipping or buying and holding. They're going to have a very fast approval process, and there's less focus on your credit score. It matters, but it's not a make or break situation. What these lenders are really focusing on is the property value. They need to know how much are you trying to purchase, how much renovation are you going to put into the property, what is going to be the ARV, or also known as the after repair value. They want to know how much are you able to pay per month. That is what really matters to these type of lenders. So let's walk through a really quick scenario on what this could look like. Let's say you find a property that's really ugly and you need to purchase it for about $90,000 to $100,000. You're able to look at the property and you factor, you know what, I need a full gut on this house. It's gonna cost me $100,000 to fully renovate this. I'll be all in for about 190. But you know that the after repair value is easily gonna be 270 or more, which means you're gonna have more than 20 to 25% equity, which lenders actually love that. That is a lot of times their threshold is about 20 to 25%. And so what they'll do is they'll fund you the money, and a lot of times what'll happen is they will fund you in stages. So based on where you're at in the renovation, they'll release certain amounts of money. Of course, your contractors, electricians, they all have to be licensed, insured. They'll work with you. They'll release payments over time. They'll need pictures, to see that, progress and work is actually being done correctly. But it is very simple, very straightforward. It can be very beneficial. Of course, they're going to have higher interest rates, but at the end of the day, it's not going to matter because this is not a long-term loan. So the third type of financing is very, very similar to the hard money loans, but it's called private money. This is where you're going to be borrowing from individuals. This may be your friends, families, other local or national investors. You can find these guys anywhere and everywhere, Facebook, Instagram, everywhere. But this is not going to come from a lender or a bank. This is an individual person like you and me who are giving out money at a set rate. And these loans can be very, very good because they can be flexible. You're going to negotiate interest rates. You can negotiate all kinds of stuff. And so these loans are amazing. But there is a huge downside if you're not careful. If you can get into this with, a friend or a family member, then this could strain some personal relationships. We all know how money makes us feel when we have it, when we lose it, when we don't have it. So this can be something that I would definitely look into. Maybe from friends or family could be good, but you have to play it very, very carefully. Another big downside is there's not a huge, big pool of people that most of us know that just have hundreds of thousands of dollars sitting around doing nothing with. So if you are gonna do this, there's some tips out there that I'm gonna give you because this can be a very fine line to walk. So I would definitely go into this having a very solid pitch, having a good deal analysis, making sure everything is broken down, that you know exactly what the money is gonna look like coming in, going out, how long things are gonna take you, your plans for, if things happen. All of this needs to be spelled out so that way you know what you're doing and your plan looks good. So now moving on to the next one, which is called partnerships. Now, partnerships are really, really good because you can actually team up with people, with other investors, other friends who are investors, and you can pool your money together. And instead of one person being able to buy, something inexpensive, 3, 4, 5 people can join together and buy something really, really big, something that's way better. You're going to get more return on your cash. Your equity grows faster. This is probably one of the better ways out of all the 7 to get into something. Now, something good about this is it shares the risk. You're not in it by yourself. More than one mind coming together is always better. So this is huge for sharing that risk, sharing responsibility, access to more capital. It's just so many benefits. Now, yes, one thing that could come up in this is definitely potential disagreements, because if you go in together, you're going to want to make sure that your partner understands how to do real estate. Because if they go into it blindly and they really want to do something, not understanding the negative connotations with it, they could ruin the whole deal and they can mess up everything. So if you're going to go down this partnership route, one thing that I would highly suggest is lay out everything clearly, define roles, make sure everyone is on the same page before you start. I myself have gotten into a couple of partnerships. I'm currently working on a potential deal with someone, and we've laid out everything. We know exactly how much money we're bringing to the table. We walk through every single step of this property. We're in complete agreement on what needs to happen as far as maintenance. We are in agreement on every single detail because it matters. So if you're going to do partnerships, just remember this one thing: talk it out and be in agreement. Now, this next one is one of my more favorite ways of purchasing distressed properties that are really ugly. Some of the other ones that we've talked about are great for maybe buying something that's new or something that's existing, doesn't need a ton of work. But this next one is lines of credit. Now, lines of credit are amazing. I use them personally to go out and purchase like foreclosures because you need cash on hand quick. when you're doing some of these deals. You could easily leverage other properties that you own. You could leverage even your personal home, although that is not a long-term strategy. I've done that myself, where your personal home's equity could be used to purchase. That's a great stepping stone and a good starting point, but it should not be what you use all the time. If you have cash saved up in a savings account or a 401k, there's potentials of leveraging those to pull money against that. If you have life insurance, there's all kinds of ways that you could get lines of credit and get money back and use that to purchase property. Now, of course, you have to make sure that you understand how lines of credit work. Most of them, the ones that I've seen, almost every single line of credit that I know of, payments are almost always interest only and never principal. So that's good because now your monthly payment is lower. You have access to the quick cash. You have a little bit more room to work with, but you have to remember that at the end of the day, you have this principal balance you need to pay for. And what's nice about these lines of credit is once you secure them, they never go away. As long as you make the minimum monthly payments, you're paying back the principal when you're done with these projects, that line of credit is revolving. It's just like a credit card. Now, again, these are not long-term solutions. These are solutions to get into the game, to buy the properties, to renovate the properties, but these are not long-term solutions. This goes back to those 3 stages. This is gonna be your acquisition and your rehab stage all day long. Here's a little pro tip. If you do have a good sizable amount of money, think about this, put it in a high yield savings account. Then you can go borrow against that high yield savings account that is, making you money monthly, quarterly, yearly, however that bank pays it. That money can help to offset some of the interest every single month in that line of credit. Now, it's not going to be all of it. More than likely, it'll be around half, but it is something that you don't have to worry about. It is less money out of your pocket every month. Now, another one that's very interesting, a lot of people don't talk about it too much, but it's seller financing. This is pretty simple, where the seller of that property is acting as the lender. This is going to allow you to pay over time just like you would on a typical mortgage or a line of credit. But it's a lot more flexible because you and that seller can come up with terms. You can have the interest rate not be set where it matches the market, so that way you're not overpaying. You can have all kinds of terms, no prepayment penalties, there could be flexibility with potentially interest only payments. I mean, the list goes on and on of what you can do and get creative with. Now, a lot of times that just simply means too less cash up front, which we all know if you don't have to pay as much and get the same thing, that's always better. But there are some downsides because a lot of times there is very limited availability with these. A lot of times sellers don't want to worry about this. If they're selling a property, they want to do just that and sell the property, get rid of it, be done with it. They don't want to worry about it anymore. So seller financing, it is a good option, but it is more difficult to find sellers willing to do these. So if you're going to go this route, definitely know what you're doing, have everything laid out. And one tip that I would give, because I've seen this happen where it wasn't done, is you want to get everything notarized. You want to get things signed. You want to potentially have lawyers look over your agreements or promissory notes. Having everything, as they say, your I's dotted and your T's crossed, having all of that set up is important, because if not, at that point, it's your word against theirs and you don't want to run into that situation. So this last area before we talk about how to combine some of these areas that we just talked about is going to be crowdfunding and syndication. This is simply where you are raising money from other investors via different platforms, private networks. You're trying to just pool a bunch of money together to go purchase property to renovate. Now, this can be very, very beneficial because you can get access to a huge pool of money, and there's less and less reliance on personal credit, if any. Now, kind of like the private money where you have to come up with a good pitch, you're gonna have to do the same thing here. You're gonna have to have a detailed plan, have everything written out, have a spreadsheet of what money is gonna look like. You're gonna have to be very detailed, come across very knowledgeable, professional, experienced. Even if you're a beginner, having everything written out is going to make this part way easier, because most of these investors that you're going to be talking to, they've been there, they've done that, they know how this game works. And if you don't understand, and if you aren't watching videos like this to understand how to get funding, you'll never get it. Now, one word of caution with this is there can be higher fees involved. because these lenders can say whatever they want, they can set interest rates, whatever they want. You got to be careful. You got to make sure you hear them out, how much they're giving you, what are their rates, what are their terms, are there any fees? You need to know all that up front. And if this is something that you're interested in, just do a quick Google search, look up crowdfunding and syndication for real estate investors. I'm sure there'll be thousands of ideas and thousands of options out there that you can legitimately go to. So now, can you combine any of these that we've just talked about? Well, the answer is yes. You can combine several of these, and we're gonna talk through some examples. So for example, something that I've personally done is I'll leverage lines of credit, maybe hard money loans to purchase properties, to rehab these properties. And once they're done, they're all said and done, I'll go out and I'll get a tenant and a renter, and then I'll refinance that property with a typical lender, do a DSCR or a debt service coverage ratio loan. I'll pull all that money back out. I'll pay off the hard money loans, the private lenders, lines of credit, whatever you did. You can start all over. And then now you have a property that has rented out. It's going to cash flow. You're going to pull all the money back out, so you're not paying these super high interest loans anymore. And that's just one way of combining multiple strategies to make this work. You could also use the private money loans, the partnerships to pool money together. I mean, there's so many different creative ways. And so I'd like to hear from you guys. Can you think of any other combinations from what we've talked about today? If so, put it down in the comments. I'd like to hear what you come up with. And who knows, I might be able to actually use them myself. So one big thing that we have to remember when we're going through, no matter which of these you choose, is the importance of presenting a professional deal package. No matter if you're going to a bank, a lender, private money lender, lines of credit you're trying to get, all of it is going to require you knowing how to present yourself, knowing the deal, knowing how the money works. And you also need to know a very important term, I mentioned it earlier, is after repair value, or ARV. Things like that, your cash flow, the expected rehab cost, having all of these dialed in is going to be so incredibly amazing, because these lenders will look at you and they'll appreciate that you know what you're doing, know what you're talking about, and they'll feel better about lending to you. Now, if you've made it this far in the video, there's two things that I want you to do. Of course, you have to like and subscribe, but I want you to be on the lookout for other videos in this series, because there's going to be opportunities to get free ebooks on everything I talk about over the next year. And me and you, we're going to go through the whole process of buying investment properties together.